Okay, so the question that we are going to look at now is here, and this one. So I've just pasted it in so that we can have it there. And I'm going to transcribe all of the figures into the tax deduction card so that I'm not scrolling up and down. But just to go through it, Philip commenced employment with Paddy Whackery in period 2 of the 2025 tax year. He didn't provide his PPS number, and we're asked to calculate his PAYE, PRSI, employee and employer, USC and net pay for each week based on the following earnings. Now in this video, I'm only going to look at the PAYE calculation. I'll do another video looking at the PRSI and then one looking at the USC. So we see in period 3 to 7, he has earnings each week with us. Now, during that period, he has not provided his PPS number to us. So he's going to fall in here into the emergency basis of tax. So for payroll people, it's very easy, where the employee provides a PPSN number. The first 4 weeks, they get the benefit of a cutoff point, but no tax credit. From week 5 onwards, no tax credit and no cutoff point. But where they don't provide a PPS number, which is in the case of Philip here, everything is at 40%, so no cutoff point and no tax credit. Okay, so I'm just going to come up here and I'm going to fill in the details that I know. So in period 3, we know that he has earnings of 650. Period 4, he earns 450. Period 5, he earns 760. Period 6, 740, and then period 7, 980. Now, he's not been taxed on the cumulative basis, so his gross pay this period is going to be the same as um, his earnings because he's on effectively the emergency basis of tax. So I'm just going to pop those in across. Because he's on the emergency basis of tax, he has no standard rate cutoff point. Okay. So his tax due at rate 1, so the 20% is going to be 0. The tax due at rate 2 is going to be all of his wages at 40%. So his 650 multiplied by 40%. So this week, his total gross tax, which is the sum of his tax at rate 1 plus his tax at rate 2, we'll add those together, and this week he will pay tax of 260, gross tax of 260. He doesn't have a tax credit because he's on emergency basis, so no tax credit. So this week his tax due will be his gross tax minus his tax credit of 0. So this week he will pay tax of 260. So this week his tax deducted will be 260. Okay, so we've come along then in week 4, and it's the same situation. It will be his gross pay. He has no standard rate cutoff point. He has, so it'll be again no standard rate cutoff point. His tax due at rate 1 will be 0 because none of it is going to be liable for tax at 20%. So his tax due at rate 2 is 450 by 40% is 180. His total gross tax is the sum of tax due at rate 1 plus tax due at rate 2. So we add the two of those together, we get 180. Again, he's on emergency tax, so no tax credit. So gross tax due this week is 180. He's not on the cumulative basis, so this week he will pay tax of 180. Week 5 then, he again is on emergency tax, no tax credit, no standard rate cutoff point. So no standard rate cutoff point, no tax due at rate 1. So this week he will pay 760 multiplied by 40%. Total gross tax will be tax due at rate 1 plus the tax due at rate 2 will give us his total gross tax. He has no tax credit, so that's going to be 0. His tax due this week is going to be his total gross tax minus 0, which is 304. And this week he will pay tax of 304. Okay, so from a payroll point of view, very easy when they're on emergency tax. It's all at 40% and it's fine. He should at this stage be going to get his tax sorted because we come along into week 6 of the tax year. His gross tax, he has no tax credit and no cutoff point, nothing due at rate 1. Tax due at rate 2 is going to be his gross pay multiplied by 40%. His total gross tax will be 296, no tax credit. So tax due this week, 296, and tax deducted this week of 296. Period 7 then, again, he has no standard rate cutoff point. His tax due at rate 1 is going to be 0 because it's all higher than his standard rate cutoff point. Tax due at rate 2 will be 980 by 40%. Add the two of those together, 0 plus 392 is 392. No tax credits. Tax due this week of 392 and tax paid this week of 392. Okay, so that is while he's on emergency tax. We're told then in period 8, his previous pay and tax details became available when he provided his PPS number. This showed previous earnings in 2025 of €1,800 and tax paid of $150. USC paid of 64. The revenue online system showed a standard rate cutoff point of 35,650 and tax credits of 3,800 and indicated that a week 1 basis of taxation should apply. So just so that I'm not scrolling up and down, I'm just going to put in the details that I know. So we're told in period 8 he earns 450. In period 9 he earns 420 plus a bonus of 200. Now the bonus is taxable, so his pay for tax this week will be 620. We're told that he had previous earnings of €1,800. Now I'm just popping them in there so that I don't forget them. Okay, so 820, and we're told that he had paid previous tax of 150. Again, I'm just popping that in so that I'll remember it. Okay. He's on a week 1 basis. So it's called the temporary or the week 1 basis. And what it means is that we look at just this week in isolation. We don't worry about what happened previously. So we're not, recalculating his tax. We're just looking at this week. We're told that he has a standard rate cutoff point of 35,650. So if we take that 35,650 and divide it by 52, because there's 52 weeks in the year, it tells us that on a weekly basis, he has a standard rate cutoff point of 685.58. And it's going to be the exact same the next week. Okay. We're told he has a tax credit on the week 1 basis of 3,800. So I'm just going to divide that by 52. And while he's on the week 1 basis, his tax credit will be 73.08. Okay, so just taking the annual figure and divided it by 52 to get our weekly figure. Again, he's on week 1, so his gross pay will be the same as his earnings. So when we come here to calculating his tax due at rate 1, what we're doing is we're looking at his gross pay for this week in relation to his standard rate cutoff point. So we see that his standard rate cutoff point is 685.58. And what that says to us is that he can earn up to that amount and pay tax at the standard rate of 20%, and that anything over the standard rate cutoff point will be taxed at 40%. So in this case, his gross pay is €450. He has a standard rate cutoff point of 685.58. So the tax, his wages will be taxed at 20% because it is lower than the standard rate cutoff point. So we're just going to say 450 multiplied by 20%. He has nothing due at the high rate because we've dealt with all of his wages. So his total gross tax this week will be €90 plus the rate 2 of 0, so €90 is his gross tax. He has a tax credit of €73.08, and the purpose of our tax credit is to reduce the amount of tax that we'll pay. So it's gross tax of 90 minus the tax credit. So 90 minus the tax credit tells us this week he owes tax of 16.92, and that is the amount that we will deduct off from this week. Okay, come along to week 9. Again, he earns 620. So we look in relation to his standard rate cutoff point. His wages of 620 are below his standard rate cutoff point of 685. So this week he will pay tax at 20% of his wages. So 620 multiplied by 20%, he will pay tax, gross tax of 124. He has nothing at the high rate because all of his wages are below the standard rate cutoff point. So this week, his gross tax, his tax due at rate 1 plus tax due at rate 2 gives us 124. He has a tax credit of 7308. So this week, he will pay 124 minus the 7308, so 5092. Okay. Okay, so that then deals with him on, so here he was on the emergency. We did 2 weeks of him on the week 1. Now, most of us are taxed under the cumulative basis of tax. And the cumulative basis of tax means that you keep recalculating. So every week or fortnight or month or however you're paid, you recalculate. So you include the earnings from the previous month and you recalculate. And this is especially useful if somebody is on, their wages may go up or down, or they take unpaid leave or something like that, where, they wouldn't get the benefit of it on a week 1. On a week 1 basis, you will never get tax back. Okay, so we didn't do any calculation there. So you can see here that like these 2 weeks, he was below his standard rate cutoff point. If this had been his standard rate cutoff point in these weeks, he wouldn't have paid tax at the high rate. So you would imagine that he's going to be due some tax back, but he won't get it back on a week 1 basis. He may more than likely get it back on the cumulative basis. But in order to calculate the cumulative basis, we need to know what has he earned so far this year. So I'm just going to add all those up, and they come to 6450. So 6450. Now, so that's taking account of what he earned with us while he was in emergency, and also what revenue advised us of his previous earnings. Also going to just do the same in terms of his tax. So he paid tax of 1649.84. I'm just going to pop that in, 1649.84. We're told, I'm just going to pop in his earnings then while I have them. So see there, 760, 860, 1080 and 430. So I'm just going to pop those in so that I'm not scrolling up and down. 860, 1080 and 430. We're told that in period 10, we received a cumulative search from revenue, which showed a standard rate cutoff point of 43,200 and tax credits of 4,200. Okay. Now, I'm just going to pop those in there so that I have them, 43,200 and 4,200. So I'm just throwing those in. Now, we're taking account of his previous earnings. So with the standard rate cutoff point and the tax credits, we look to what period we're in the year. So if we're in period 10, the person is entitled to 10 weeks of a standard rate cutoff point and 10 weeks of tax credits. And the reason for that is because we've rolled all the salary together. It wouldn't be fair then to only give them 1 week of a standard rate cutoff point. So if you're rolling up the salary, you also have to roll up the standard rate cutoff point and the tax credits. So to do that, we're just saying, so 43,200 divided by 52 works out at 830 euros 77. Okay, so he's going to be entitled to 10 of those. Now I'm going to cheat and get Excel to do it for me. So I'm just saying his standard rate cutoff point divided by 52 to give me the weekly amount, and then multiply it by whatever week number we're in. So in this case, it worked out at 830 euros 70 per week. He's entitled to 10 of them, 11, 12, and 13 of them. Okay, so it's just 43,200 divided by 52 gives us his weekly amount, and then multiply it by 10 weeks, 11 weeks, 12 weeks, 13 weeks. So whatever week we are in the year. I'm just going to do the exact same thing with the tax credits. So the annual amount divided by 52, and we're just going to again multiply by the week number. So okay, fill it down. Now, so we know what his cumulative gross pay was at the end of period 9. So by the end of period 9, he had earned 6,450. In period 10, he earns 760. So this week, he has so far earned this year 6,450 plus the 760. Okay, so far this year, he has earned 7,210 euros. 7210 is below his standard rate cutoff point of 8307.69. So this week, he will pay all of his wages of 7210 should be taxed at 20%. Okay. None of it is due at the high rate because it's well below the standard rate cutoff point. So his total gross tax is going to be this plus this is 1442. He has a tax credit of 807.69. So we're just going to say 1442 minus the 807.69 comes to 634.31. So what that is telling us is, based on his earnings of 7210, he should have paid tax of 634.31. Okay. Now we know he has paid tax of 1649.84. So this week he's going to get a refund of the difference between those. So it will be 1649.84 minus 634. Okay. So this week he's very happy he's getting a refund of 101553. Okay. So we come along then in period 11 and we're saying, okay, at the end of period 10, he had earned 7210. He now has earned an additional 860. So this week he has total earnings of 8070 against a standard rate cutoff point of 9138.46. So his earnings are below his standard rate cutoff point, so his tax will be at 20%. So 8070 multiplied by 20%. He'll pay nothing at the higher rate, so his gross tax will be 1614. He has a tax credit of 888.46, so his gross tax less his tax credits come to 725.54. So what that's saying is he should have paid tax of 725.54. He has paid tax of 634.31. So this week he'll pay the difference between these two. So 725 minus the tax paid. This week he will pay tax of 91.23. Okay. So period 12 comes along then, he earns an additional 1080. So he has now cumulative earnings of 9150. Again, it's below his standard rate cutoff point. So this week he will pay tax all at 20%. So the 9150 multiplied by 20% works out at 1830. He won't pay anything at the high rate. So his total gross tax will be 1830. He has a tax credit of 969.23. So this week he will pay his gross tax minus his tax credit. Says that he should have paid 860.77. He has paid 725.54. So this week he will pay the difference between those. This week he will pay 135.23. Okay. And in the last week then he has additional earnings. So he has earned 9150. This week he earns 430. So that gives him total earnings of 9580. Again, it's well below his standard rate cutoff point, so he will pay it all at 20%. So 9580 multiplied by 20% is 1916. He won't pay anything at the high rate because it's well below his standard rate cutoff point. So total gross tax this week of 1916 plus 0 gives 1916. He has a cumulative tax credit of 1050. So this week he should have paid 866. We can see that he had paid to the end of period 12, 860. So he'll pay the difference between those. And this week he will pay €5.23. Okay. So